Everybody, it's Peter Schiff. It's Friday, October 1st, 2010. Well, first day of a new month and a new record high for the price of gold. It was up about $10 today. Silver hit a new 30-year high, up about 30 cents. Gold stocks, the Huey Index, hit a new 52-week high, but it still came a little bit shy of taking out that high from March of 2008. I have a pretty good feeling we will take it out early next week, though. Oil had a really strong day to finish a strong week. It was up $1.60. Oil closed at $81.60 per barrel. The dollar index is at a new low for the move. It's now just at 78 even, maybe 78.10. It's now dropped 13% since its peak a little over 3 months ago. You know, I noticed in the news, Susie Orman was on The View, and she was actually asked about gold. And she thought, it was okay if you buy gold. But what she said was, just buy a tiny bit of it, and whatever you do, don't buy real gold. Don't take actual possession of coins. Buy an ETF, but just a tiny bit, and watch it really closely because it's very volatile and it could drop a lot. Now, I would hardly say that is a wholehearted endorsement on the part of Susie Orman, so doesn't sound like much of a gold bubble to me. And remember, Dave Ramsey, he has an advice show. And a couple of years ago, somebody who read my book called up Dave Ramsey and wanted to know if he should buy gold, because I advised buying gold, and it was about $800 an ounce. And he said, absolutely not. He said I was an idiot for recommending gold, that gold was a stupid investment, that he had never bought gold before in his life and never would. So maybe when we're in a gold bubble, Dave Ramsey will actually be recommending that people own gold, and who knows, he might even own a couple of ounces himself. Now, now that we finished the month of September, you hear a lot in the media about, this is the best September in 71 years. Because September is typically a down month, and here not only was the Dow and the S&P up, but it was the best month in 71 years. The Dow gained 7.7%. And the S&P gained 8.8%. Well, I figured let's take a look at how other things did, other than the Dow. The CRB index, which is a broad index of commodities, gained 8.7%, about exactly the same as the S&P, and a little bit more than the Dow. But let's break it out a little bit and take a look at some of the individual components. Soybeans in the month of September were up 9.5%. Beat the S&P and the Dow. How about copper? Up 10%. The copper plumbing in my basement did better than the Dow, even though it was a record September. What about rice? Rice is up 10%. That box of Uncle Ben's in my cabinet, that Uncle Ben's rice beat the S&P month of September. Oil was up 11% in the month of September. Not counting the big gains today. That means that jar of motor oil in my garage did better than the Dow. Corn was up 12% in the month of September. Corn, a box of Orville Redenbacher, popping corn, beat the Dow in the month of September. Silver did 13% in the month. Those silver coins that are in a jar in my bedroom beat the Dow. What about frozen concentrated orange juice? Did 13% in the month of September. That Tropicana orange juice, that container in my freezer, did better than the Dow in the S&P in the month of September. Get this, the price of cotton up 17.5% in the month of September. My jockey shorts outperformed the Dow in the month of September. How about sugar? 19.3% increase in 1 month in the month of September. The Domino sugar in my kitchen cabinet beat the S&P. Look at some of the other currencies, how they did. Just currencies were up. Swiss franc was up 4.6% on the month. The euro was up 7% on the month. The Australian dollar was up 9%. That means if you just stuffed Australian dollars in your mattress, you beat the S&P in the month of September, despite the fact that it was the best September in 71 years. Now I ask you, given this, right, do you think stocks really went up in value in the month of September? Or is it more likely that the dollar lost value? And because the dollar lost value, the price of everything went up, including the price of stocks, which didn't even go up as much as a lot of other things that I just read off. And of course, those weren't the only items that outperformed the Dow. there were many more. Now, given all these big increases in price, look at what's happened today. We got the core PCE came out today, which is the Personal Consumption Expenditure Index. The Fed likes this index as its preferred measure of inflation. And even that preferred measure, which I think is bogus, shows that prices went up by 1.5% in the last year. So the CPI went up by 1.5%. And even today we got ISM prices paid index surged from 61.5% to 70.5, from 61.5 to 70.5 in 1 month, which was a huge jump in prices despite weakening economic numbers. But look what the Federal Reserve Open Market Committee said today. I'm going to read you their statement. Measures of underlying inflation are currently at levels somewhat below those the committee judges most consistent over the long run with its mandate to promote price stability. Wait a minute. Prices are rising by 1.5%, and they don't think that's enough. And the central bank went on to say the central bank is prepared to provide additional accommodation if needed to support the recovery and return prices to more desirable levels. Well, they mean higher levels. Prices are already rising, and the Federal Reserve is saying they're not rising fast enough. Now, I wonder, what is a desirable level of inflation? The Fed has now been transformed from an inflation fighter, in theory anyway, to an inflation promoter. The Fed is saying that there's not enough inflation. I wonder how much higher prices the Fed thinks we need to endure before they think they've done their job. I mean, you have all these unemployed Americans. I wonder how much more expensive the Fed thinks food should be, or energy should be, or clothing should be, before they think they can pat themselves on the back. Now, more important, what about this guy, William Dudley, came out today, who's the president of the Federal Reserve Bank of New York. This is what Dudley had to say. I'm going to read his comment. The current level of inflation and the time frame over which it is likely to return to levels consistent with our mandate is unacceptable. The longer this situation prevails and the U.S. economy is stuck with the current level of slack and disinflationary pressure, the greater the likelihood that a further shock could push us closer to outright deflation. The risk that inflation expectations rise because of asset purchases can be countered by a credible plan from the Fed to exit the unprecedented stimulus with tools such as term deposits. You're right, a credible plan. Then he said this: there is nothing to worry about on expanding Fed exposure to higher short-term interest rates. I'm relieved. The Fed tells me I shouldn't worry about the problems of interest rates ultimately rising. And here's the end. Further action is likely to be warranted unless the economic outlook evolves in a way that makes us more confident that we will see better outcomes for inflation. Now, what he means by better outcomes is higher inflation. Here it is. Inflation is still going up, and the Fed is telling us that they're uncomfortable because inflation is not as high as they want. It's already rising at 1.5%. I mean, what is comfortable? Is 2% high enough? Is 3% high enough? The Fed's not telling us how much inflation they consider to be desirable. Remember, when Nixon imposed wage and price controls in 1974, it was because inflation got as high as 4%. I wonder what the Fed would regard as 4% inflation. Is that enough? They're not telling us. But what we do know is they're uncomfortable with annual price increases that are only 1.5%. Even with the new data, a collapsing dollar, surging commodity prices. I mean, what does the Fed think? Does the Fed think that none of these rising commodity prices are going to factor into consumer prices? I mean, how could they not? The whole thing is ridiculous. And with the dollar plunging like a stone, you would think that the Fed would realize that whatever the inflation rate is right now, it's going to go higher on its own. But the Fed doesn't want that. The Fed wants to make sure that inflation rises faster, and it's going to do what it can to do that. You know what? Take them at their word. And if you want to avoid the inflation tax, get out of the dollar. I think the dollar is the riskiest asset you can hold right now because the Fed is telling you they are going to debase the value of our money. They are going to make prices rise. And if you don't want to lose your wealth, then you got to get rid of the dollar. Final thoughts today. I know Rahm Emanuel, the president's chief of staff, resigned today, and he praised Obama for his courage and saving us from a repeat of the Great Depression. He didn't save us from anything. All he's done is guaranteed that not only will we repeat the Great Depression, but it's going to be even worse than the one in the 1930s. And of course, it's going to be an inflationary depression, which will be that much more painful for everybody. Anyway, that's it for me today. Have a good weekend, and I will try to blog again. I'll be out of the country for the next week. Take care, everybody. So long.